Strategic Analysis of the Global Copper Market and High-Growth Small-Cap Mining Equities for 2026. The global copper market in 2026 has transitioned into a new era where the metal is no longer viewed as a cyclical industrial commodity, but as a foundational strategic asset critical to the dual pillars of the 21st century economy, digital infrastructure, and the global energy transition. This red-gold narrative is underpinned by a structural deficit emerging from decades of underinvestment in mining capacity, coupled with an unprecedented step change in demand from high-growth sectors such as artificial intelligence or AI, data centers, and the modernization of electrical grids. As copper prices frequently challenge and exceed levels of $13,000 per metric ton, market participants are increasingly focusing on upstream resource plays, particularly small-cap and junior miners that control Tier 1 assets in stable jurisdictions. These companies offer the highest leverage to a multi-year structural repricing, though they also carry significant operational and jurisdictional risks. The 2026 macroeconomic landscape, a market in deficit. The primary driver for the copper market in 2026 is the persistent imbalance between refined supply and a structurally expanding demand profile. J.P. Morgan Global Research anticipates a global refined copper deficit of approximately 330,000 metric tons for the year, a shortfall that has been exacerbated by a series of acute supply disruptions at major mines. One of the most significant impacts came from the world's second-largest copper mine, Grasberg, in Indonesia, where a fatal mudslide triggered a force majeure in late 2025. The Grasberg block cave portion, representing 70% of the mine's previously forecasted production, is not expected to resume operations until the second quarter of 2026, creating a significant hole in global supply. Mine supply growth for 2026 is currently estimated at only plus 1.4%, which is approximately 500,000 metric tons lower than initial projections. This limited growth occurs against a backdrop of declining ore grades across established copper districts and lengthening lead times for new mine developments. Consequently, the ability of large-scale producers to ramp up production in response to high prices is severely constrained. Demand transformation, AI, grid modernization, and national security. The narrative surrounding copper demand has shifted from traditional manufacturing and construction to high-tech and strategic applications. The explosive growth of AI infrastructure and the associated need for compute power has turned data centers into a major new consumer of the red metal. In 2026, data center installations are projected to consume 475,000 metric tons of copper, an increase of 110,000 metric tons over the previous year. Digital infrastructure typically requires high copper intensity, estimated at 12 to 15 tons of copper per megawatt of capacity, primarily for power distribution, cooling systems, and specialized wiring. Simultaneously, the global push toward net zero targets and renewable energy integration is driving massive investments in smart grids and electrical infrastructure. Grid-related demand is projected to account for more than 60% of copper demand growth through 2030, essentially adding the equivalent of the total consumption of the United States to the global market within this decade. Transport electrification also remains a robust driver, with global electric vehicle, or EV, sales reaching 13.6 million units in 2024 and maintaining growth rates of 25 to 35% annually through 2026. Each EV contains significantly more copper than a conventional combustion engine vehicle, contributing to a cumulative demand increase of 350,000 to 450,000 tons from this sector alone. Beyond industrial and technological use, copper is increasingly framed within a national security context. Initiatives focused on supply chain resilience and infrastructure modernization have led governments to prioritize domestic production. This strategic framing supports elevated pricing and creates a bifurcation in equity performance, favoring miners in low-risk jurisdictions that can provide secure, long-term supply. Here is a summary of 2026 market metric estimates from institutional sources. J.P. Morgan has estimated global refined deficit of 330,000 metric tons for 2026, mine supply growth of plus 1.4%, data center copper demand of 475,000 metric tons, average copper price of $12,075 per ton, and quarter two peak copper price of $12,500 per ton. Goldman Sachs forecast for fair value, copper price is $11,500 per ton, and year-end price forecast is $11,000 per ton. Pricing dynamics and technical analysis for 2026. Institutional forecasts for copper prices in 2026 vary, reflecting different assumptions regarding the global supply balance and the timing of U.S. trade policies. J.P. Morgan remains bullish, projecting that prices will average $12,075 per metric ton for the full year, peaking at $12,500 per metric ton in the second quarter. Citigroup, or Citi, has suggested that if supply shortages and low inventories persist, copper could potentially exceed $13,000 per ton and even approach $15,000 per ton during 2026. However, Goldman Sachs research offers a more moderated outlook, expecting prices to decline somewhat from recent record highs of $11,771 per metric ton. Goldman's base case predicts a market surplus of 160,000 to 300,000 metric tons in 2026, which they believe will prevent prices from exceeding $11,000 for a sustained period. A significant catalyst for a potential price correction is the implementation of U.S. refined copper tariffs. The Trump administration is expected to announce a 15% to 25% tariff by mid-2026, which may signal the end of a stockpiling cycle in the U.S. and allow global prices to move lower toward a fundamental fair price of $11,500 per metric ton. Technical momentum and market sentiment. Technical indicators in early 2026 suggest that copper remains in a robust long-term uptrend. Prices on the London Metal Exchange reached record highs of $13,238 per ton in January 2026, with the metal trading consistently above the $5.80 per pound level on the COMEX. Monthly charts show prices hugging the upper Bollinger Band, indicating strong momentum and a phase of trend expansion. The average directional index, or ADX, is near 40, confirming a strong trend, while the rising average true range, or ATR, reflects the volatility typical of a major acceleration phase. Key technical levels for the remainder of 2026 include near-term support at $5.10 per pound and deep support at $4.40 per pound. On the upside, targets include $6.20 per pound and potentially as high as $7.00 per pound if the scarcity narrative continues to drive institutional rotation from gold and silver into base metals. Investment infrastructure. Accessing copper exposure, investors can gain exposure to the copper theme through physical assets, digital derivatives, or mining equities, each with unique tax and liquidity profiles. ETFs and mining equities, exchange-traded funds, or ETFs, remain the most popular vehicle for both retail and institutional investors. Broad mining ETFs, such as the Global X Copper Miners ETF, ticker COPX, and the iShares Copper and Metals Mining ETF, ticker ICOP, provide diversified exposure to established majors like Freeport-McMoRan, BHP Group, and Rio Tinto. These funds allow investors to benefit from operational leverage and dividends, which many major miners pay, thereby adding a layer of return beyond simple price appreciation. However, large-cap miners are rarely pure plays, as they often produce significant quantities of gold, iron ore, or molybdenum, which can dilute copper exposure. For direct tracking of the copper price, the United States Copper Index Fund, ticker CPER, utilizes a portfolio of copper futures contracts. While CPER offers high liquidity, it is subject to roll yield, the cost of rolling expiring contracts into new ones. In a contango market, where future prices are higher than current prices, this roll cost can erode investor returns over time. Furthermore, CPER is structured as a partnership, requiring investors to handle K-1 tax forms, which may be a deterrent for some retail participants. The growth case for small-cap miners. The small-cap mining sector is particularly attractive in 2026 due to the potential for discovery-driven revaluation and acquisition premiums. Small-cap miners often control individual Tier 1 projects that are undervalued relative to their long-term potential. The Sprott Junior Copper Miners ETF, ticker COPJ, specifically targets this segment, tracking mid, small, and micro-cap companies. In early 2026, COPJ has demonstrated exceptional momentum, with a 132% gain over the past year and net assets exceeding $200 million. Summary of key copper-focused exchange-traded funds. COPX Global Copper Miners, $5.2 billion in assets under management, 0.65% expense ratio, plus 95.3% one-year performance estimate. COPJ Junior / Small Cap Miners, $203 million in AUM, 0.76% expense ratio, plus 134.0% one-year performance estimate. CPER Copper Futures Contracts, $460 million in AUM, 1.06% expense ratio, plus 40.1% one-year performance estimate. ICOP Global Copper and Metal Miners, $232 million in AUM, 0.47% expense ratio, plus 79.8% one-year performance estimate. COPP Physical Copper and Miners, $97 million in AUM, 0.65% expense ratio, plus 71.7% one-year performance estimate. Profiles of top small-cap copper miners for 2026. The following companies represent the top tier of small-cap copper developers and explorers, distinguished by asset quality, jurisdictional safety, and strategic backing. Arizona Sonoran Copper Company Trading Ticker, TSX, ASCU. Arizona Sonoran is an emerging U.S. copper developer focused on the 100% owned Cactus Project in Pinal County, Arizona. The project is a brownfield redevelopment on private land, which provides a significant advantage in the permitting process, as there is no federal nexus for the primary environmental approvals. In late 2025, the company released a pre-feasibility study, or PFS, demonstrating exceptional economics for an open pit, heap leach, and SX-EW operation. The study outlines the production of approximately 103,000 tons of LME-grade copper cathode annually over the first 10 years of a 22-year mine life. This would position Cactus as the third largest copper cathode producer in the United States. The financial metrics of the Cactus project are highly robust. At a base case copper price of $4.25 per pound, the project generates an after-tax net present value, or NPV, 8% of $2.3 billion, and an internal rate of return, or IRR, of 22.8%. At $5.00 per pound, the NPV increases to $3.3 billion with a 28.7% IRR. Arizona Sonoran has maintained an industry-leading capital intensity of $10,894 per ton of cathode produced, with a life-of-mine C1 cash cost of just $1.34 per pound. The company enters 2026 in a strong financial position, with a cash balance of approximately $105 million to start the year. The 2026 work plan, budgeted at $75 million, includes early development activities such as procurement of long lead items like transformers and switchgear, infill drilling to define proven mineral reserves, and the completion of a definitive feasibility study or DFS. Arizona Sonoran has already received several key permits, including the industrial dust permit in January 2026, and anticipates being fully permitted following the DFS in late 2026. The strategic involvement of Rio Tinto through its Newton Venture and Hudbay Minerals as a major shareholder further validates the project's technical and economic promise. Solaris Resources symbols TSX, SLS, NYSE, SLSR. Solaris Resources is advancing the world-class Warintza copper project in southeastern Ecuador. Warintza is regarded as a Tier 1 generational discovery, characterized by its high-grade, near-surface mineralization and extremely low strip ratio of 0.53 to 1. A landmark pre-feasibility study released in late 2025 reported a 312% increase in measured and indicated resources, supporting a maiden mineral reserve of 1.3 billion tons at 0.41% copper equivalent. The study projected an average annual production of 300,000 tons of copper equivalent over the first 5 years, with all-in sustaining cash costs of $1.07 per pound over the first 15 years. These costs place Solaris among the world's lowest-cost producers. The project's post-tax NPV8 is estimated at $4.6 billion, with a 26% IRR. Solaris is pursuing a district-scale growth strategy, recently acquiring an option for an additional 40,000 hectares of adjacent exploration concessions. Early-stage sampling at these new anomalies has returned results of up to 8.38% copper. The company is fully funded to a final investment decision, or FID, targeted for the end of 2026 through a $200 million financing package from Royal Gold. While political uncertainty in Ecuador remains a factor, Solaris has secured deep community support through an impact and benefits agreement with local Shuar communities. Firefly Metals symbol ASX, FFM. Firefly Metals is an emerging copper-gold company revitalizing the high-grade Green Bay copper-gold project in Newfoundland, Canada. The project is headlined by the Ming underground mine, which currently contains a mineral resource estimate of 50.4 million tons at 2.0% copper equivalent. Since acquiring the project in 2023, Firefly has pursued a low-cost resource growth strategy, utilizing 6 underground rigs to expand zones and convert inferred material into measured and indicated categories. The company has already achieved a 51% increase in the mineral resource and is targeting the release of its first preliminary economic assessment in the first half of 2026. Firefly is well capitalized, ending late 2025 with a cash balance of approximately 230 million Australian dollars. A TEX Resources symbol TSXV::ATX. ATX Resources is exploring the Valeriano copper-gold project in Chile's emerging Link Belt, a prolific porphyry corridor located between the El Indio and Maricunga belts. Valeriano has emerged as the largest copper discovery in Chile in over a decade, with an indicated resource of 475 million tons at 0.88% copper equivalent and an inferred resource of 1.5 billion tons at 0.75% copper equivalent. In early 2026, ATEX reported a series of high-grade assay results from its Phase 6 drill program, which is systematic testing the B2B breccia system. Highlight drill holes included ATX-D26B, which intersected 186 meters of 2.13% copper equivalent, and ATX-D32, which intersected 56 meters of 2.36% copper equivalent. These results demonstrate the robustness and continuity of a high-grade core that remains open along strike and down dip. ATEX is backed by Agnico Eagle Mines, which holds a 13% stake and is led by a new management team following the appointment of Chris Beer as interim CEO in February 2026. The company's market capitalization has grown to over $1.3 billion as investors recognize the scale and strategic importance of the Valeriano discovery in the Atacama region. Trilogy Metals tickers TSX, TMQ, NYSE, TMQ. Trilogy Metals is developing the Upper Kobuk Mineral Projects, or UKMP, in Alaska's Ambler Mining District through a 50-50 joint venture with South 32 Limited. The joint venture's flagship asset, the Arctic Project, is one of the highest-grade undeveloped copper deposits globally, hosting 35.7 million tons of indicated resources, grading above 5% copper equivalent. The 2026 program for Trilogy is focused on initiating the permitting process for Arctic and advancing technical de-risking. The joint venture plans to target mine permit submissions in 2026, potentially leveraging the FAST 41 federal framework for expedited permitting of critical infrastructure projects. Trilogy maintains a strong cash position of over $50 million and has received a $35.6 million investment from the U.S. government to advance exploration and development at UKMP. The Arctic Project's feasibility study outlined a potential 13-year mine life with an after-tax NPV of $1.1 billion and a 22.8% IRR. The district also contains the large bornite deposit, which has the potential to extend the mine life beyond 30 years. A critical catalyst for Trilogy is the advancement of the Ambler Access Project, a proposed 211-mile industrial road that will connect the mining district to the Dalton Highway. Faraday Copper symbol TSXFDY. Faraday Copper is focused on the Copper Creek project in Pinal County, Arizona, which combines high-grade breccia mineralization with large-scale porphyry deposits. The project hosts a measured and indicated resource of 4.2 billion pounds of copper, and a 2023 Preliminary Economic Assessment, or PEA, outlined a 31-year mine life with a post-tax NPV of $713 million and a 15.6% IRR. In January 2026, Faraday received approval for its Exploration Plan of Operations, or EPO, from the Bureau of Land Management, or BLM, allowing access to 67 drill pads. This approval has enabled the company to initiate its largest ever drill program, a 40,000-meter Phase 4 campaign. The program is focused on expanding near-surface oxide resources to enable low-cost, heap leach copper cathode production and testing for new discoveries in the district. Metallurgical results for Copper Creek have been positive, confirming high copper recoveries, 95%, through the application of coarse particle flotation, or CPF. This technology allows for a larger grind size, potentially reducing grinding energy by 50% and significantly increasing mill throughput. Faraday is led by Paul Harbage, a geologist with a proven track record of discovery and successful company exits. Comparative project overview of top small-cap copper miners for 2026. Arizona Sonoran, ASCU, Cactus Project, Arizona. Stage, feasibility study/permitting. Estimated market cap, $1.0 billion. Estimated cash balance, $105 million. Faraday Copper, FDY, Copper Creek Project, Arizona. Stage, exploration/preliminary economic assessment. Estimated market cap, $800 million. Estimated cash balance, $46 million. Solaris Resources, SLS Warintza Project, Ecuador. Stage, feasibility study/permitting. Estimated market cap, $1.2 billion. Estimated cash balance, $200 million from Royal Gold. Firefly Metals, FFM, Green Bay Project, Newfoundland. Stage, preliminary economic assessment, first half 2026. Estimated market cap, $943 million. Estimated cash balance, $230 million Australian dollars. A TEX Resources, ATX Valeriano Project, Chile. Stage, exploration/resource. Estimated market cap, $1.3 billion. Estimated cash balance, $30 million. Trilogy Metals, TMQ, Arctic Project, Alaska. Stage, permitting/feasibility study. Estimated market cap, $1.0 billion. Estimated cash balance, $50 million. Taseko Mines, TGB, Florence Project, Arizona. Stage, production/ramp-up. Estimated market cap, $2.9 billion. Cash balance, strong cash flow. Comparative project economics and financial resilience. The small-cap copper sector in 2026 is defined by a flight to quality. Investors are increasingly discriminating between companies based on their capital intensity and their ability to generate free cash flow at lower copper prices. Arizona Sonoran's Cactus Project and Solaris Resources' Warintza Project both stand out for their first quartile cost profiles, with all-in sustaining costs, or AISC, estimated near or below $1.60 per pound and $1.10 per pound, respectively. These low-cost operations provide a significant buffer against potential commodity price, volatility, and interest rate fluctuations that may impact the broader mining sector. Financial strength is also a key differentiator. Firefly Metals and Arizona Sonoran have both completed significant equity raises in late 2025, ensuring they are fully funded to execute their 2026 work programs without further dilution. This is particularly important for junior miners, as the funding gap between discovery and production is often the period of highest risk for shareholders. Strategic partnerships and merger and acquisition activity. The presence of strategic partners in the capital structures of small-cap miners acts as a powerful seal of approval. Nuton, Rio Tinto, Agnico Eagle, and South 32 are actively involved in the small-cap copper space, providing technical expertise and a potential exit path for investors through future acquisitions. The involvement of major mining houses also helps to de-risk projects for debt providers, a critical step as junior companies transition toward construction. End of the video right now. Leave a comment down below. Share with us what you think about our copper miners analysis. Are you purchasing more? Are you maintaining your position strongly? Or are you remaining on the sidelines? We genuinely want to hear from you. And if this video opened your eyes to what's approaching in the silver market, please hit that like button. Don't forget to subscribe and activate notifications, because the financial storms ahead are only just beginning, and we'll be here to guide you through every single step of the way. See you in the next one. Stay safe, stay informed, and stay positioned for what's approaching.